We all hear about how real estate creates more millionaires than any other thing in America. The big question is how. Today, we'll be discussing how appreciation, depreciation, amortization, and cash flow contribute to the accumulation of wealth for those willing to acquire income-producing assets. Hey, House Stackers, welcome to episode 17 of the Stacking Houses podcast, where we're helping working professionals create a solid plan B, a side hustle of passive streams of income through real estate investing. I'm your host, Damon Santamaria, and my goal for each show is to provide you with some practical and inspiring information so that you can create a solid financial plan for yourself. So to help you on your journey, I want to give you a sample property pro forma, which will allow you to calculate both the amortization and cash flow so that you can estimate these when looking at your own deals. And you can pick this up simply by going to stackinghouses.com/pro forma. And while you're there, you can also check out our free training on where Jim and I are finding great deals in today's landscape. So as I mentioned in the intro, there are 4 key areas of real estate that makes it such a powerful tool for wealth accumulation. And again, these are appreciation, depreciation, amortization, and of course, my favorite, cash flow. Many first-time investors will mainly focus on appreciation and cash flow, but will fail to consider amortization and depreciation into the deal, and this can be a big mistake, as we'll soon discuss. So let's first start off by reviewing appreciation. Appreciation, in simple terms, is how the value of the property will go up over time. Obviously, the opposite can happen, and the value can go down as well. When considering appreciation, we often ask ourselves, is it a good time to buy? Is it a bad time to buy? Is the prices going up, down? And the truth is, no one really knows. We can certainly make predictions, and because real estate is slower moving than, let's say, a stock, we think that we'll have enough time to sell before things get too bad. However, I've seen many a house flipper and a developer get caught up in a frenzy only to see that the market turns and it puts them out of business because they become over-leveraged and can't sell fast enough. So with this regard, appreciation can be extremely speculative. Now, for the last 10 years, the market has really only gone up since the Great Recession. And now with COVID, it really is a seller's market where there are multiple offers, well over asking price. So, one of the best ways to play a high appreciating market is to do what's called a cash out refinance, where you pull out the equity from the property and use it to buy more real estate. So I've done this several times with my primary house and was able to take that debt equity, which isn't providing any return, and use it to expand my portfolio. And the way I look at it is that I'm trading a 3% loss, which is typically what I'm refinancing at, and getting a 10% cash-on-cash return for a net gain of 7%. So in addition to the 7% money arbitrage, I'm also getting greater depreciation benefits and taking on more debt. And this leads us to the next subject, which is depreciation. So depreciation is a tool that investors deduct from the cost of the asset, including the buying and improving of that asset over its useful life. As an investor, you have the ability to depreciate a single-family home on a 27.5-year schedule. This means that the IRS recognizes the fact that over time, any item will degrade and in theory will be worth less the following year. But we as real estate investors know this is rarely the case since we're going to maintain the property, and historically the value of the property actually increases over time. So it's helpful to think of depreciation as a phantom non-cash expense which helps erase real gains on paper. The corresponding result lowers your ordinary income, thus lowering your taxes. Additionally, you can perform what's called a cost segregation study, which identifies and reclassifies property assets in shortening the depreciation time schedule, which reduces your current income tax obligations. For example, items like appliances and flooring depreciate at a much faster rate on a 5-year schedule, allowing for greater tax savings. Commercial real estate follows a 39-year depreciation schedule, which lessens the amount of annual write-offs. This is one reason why I favor residential income properties. And it's also to help think of depreciation as the best kind of expense, literally a gift from the IRS. The IRS wants to encourage investors to take risks and continue to buy more real estate because it's a significant contribution to the U.S. economy. But what the IRS gives, they can also take away. And when you go to sell your property, the IRS will attempt to do what's called a recapture of the depreciation expense that they've allowed you to take over the life of that investment. There is a way to defer taxes indefinitely through what's called a 1031 exchange, which we'll discuss in greater detail on another podcast. There are many factors which can affect how depreciation, recapture, and 1031s can maximize your legally help you reduce your tax exposure. So you want to seek the advice of an accountant and or a tax expert who can counsel you for your specific situation. So now let's change gears and discuss amortization. Amortization is the amount of principal paydown on your loans over time. And this is a cash benefit that indirectly goes into your pocket through equity into the property, assuming that the property either stays the same in value or appreciates over time. When I do my monthly accounting, I have a line item on this on my monthly spreadsheet, which is additive to the cash flow I receive each month. The reason I love amortization so much is that your tenants are actually paying this down. They're the ones paying for your property. And, this is the difference between your primary house and a rental property. With your primary house, money is coming directly out of your pocket for that very expensive house that you live in. Amortization in combination with appreciation is extremely powerful because it allows you to continually expand your portfolio through the cash out refinance process that I just spoke about. The main variable of these two items is time. Obviously, the more amount of time that you have to hold a property, the more the equity is building up. That's why the old famous slogan holds true till today. Don't wait to buy real estate and wait. Okay, so we've discussed appreciation, depreciation, and amortization. Now I want to talk about what I consider to be the main reason why I invest, and that's for cash flow. As a long-time buy and hold investor, I live off the monthly cash flow that my investments produce. This is one that's not easy for many people to kind of accept because most rental properties only produce between $300 and $500 per month in rental income. And at this rate, it takes a lot of properties and a lot of time to replace your W-2 income. It takes patience and dedication to find the right properties, acquire them, and begin cash flowing. And for many folks, the faster path is to fix and flip for quick gains. And this is a great strategy as well, but you don't receive any of the 4 benefits that I just laid out. Furthermore, it's not passive like buy and hold investments. It takes a lot of work to find properties below market value. It takes a lot of work to find contractors and supplies, especially in this market with supply chain strains on the economy. And it can also be expensive to find short-term financing to fund your flip. I actually use this strategy to flip my long-term properties just before I sell them to avoid some of these headaches. But anyway, back to cash flow. So cash flow is a very reliable source of income, and it allows you to stair-step your way to financial freedom. And once you have a solid base, perhaps enough to replace your day job income, you can continuously build and build and build, and the sky is the limit. This same base will allow you to begin acquiring at a faster rate because you'll soon have an excess of cash over and above your living expenses. Also, the larger the base, the larger amount of equity you have in multiple properties, allowing you to continuously refi and pull equity out for greater expansion. And this is what the wealthy know so well. They know if they want to build something for personal consumption, all they have to do is acquire an asset that produces enough monthly cash flow to pay for that car, that boat, or in my case, my kids' private school education. It's the goose that lays the golden eggs, and you never want to kill the goose. You simply want to take those golden eggs for whatever you want in life. So I hope this has been helpful because it's a part of real estate investing that few people take into account when considering real estate investing as a viable option. So if you like what you heard today, I would appreciate a like, a share, a review on the platform you're listening to. And for those of you watching on YouTube, there's a subtle hint right behind me. And, it really does help us little guys that are just getting started out on our podcast journey. And it also helps you and other house stackers find our content. So as I mentioned at the beginning of the show, I want to give you that sample property pro forma, which will allow you to calculate the amortization and cash flow so that you can estimate these when looking at your own deals. And you can pick this up simply by going to stackinghouses.com/pro forma. And until next time, happy investing, my friends.